Anyone who struggled with credit card debt in the past can likely relate to the fact that it can feel like an endless cycle that we can never get out of. High interest rates can quickly consume us, making it extremely difficult to get out of debt. So in today's video, we're going to explore why mathematically it likely makes sense for anyone with credit card debt to use the velocity banking strategy. And although when many people hear about velocity banking, they immediately think about using a HELOC to pay down their mortgage. However, the strategy really does expand well beyond just using it to pay off a mortgage. And luckily for us, the strategy we're going to look at in this video does not require a HELOC or a personal line of credit to be successful. And be sure to stay to the end of the video where we share how much an individual with $14,855 in credit card debt can save in 1 month with the velocity banking strategy. Before we jump into our example, our one ask is if you do get some value out of this video, be sure to leave a thumbs up and consider subscribing to the channel for more content related to velocity banking and everyday finance. And please note that nothing on this channel is financial advice. It is always important to do your own research and speak to the proper licensed financial experts who can help you make the best decision for your unique situation. So without wasting any more time, let's dive into why we think mathematically it makes sense to use velocity banking to pay off credit card debt. And as we go through our example, we do want to call out that we will not be using any sort of personal line of credit or 0% APR offer. However, we do recognize that this can help supercharge a velocity banking strategy and is worth looking into for individuals who can get access to things such as a 0% transfer balance offer. To better understand the strategy, let's dive into an example. Frederick currently has a balance of $14,855 on his credit card that carries an interest rate of 22%, that he is of course looking to pay off. However, we do recognize that many individuals who have credit card debt have more than one credit card that they're looking to pay off. If you're someone in this situation, the strategy can still be successfully implemented, and we'll do our best throughout this video to point out where things will need to be done slightly differently. To understand how Frederick can start paying off his credit card, we need to get a better understanding of his monthly income and expenses. Frederick currently has a monthly income of $5,820 and $4,650 in monthly expenses. The next thing that Frederick is going to do is then determine from his $4,650 in monthly expenses which ones are eligible to be paid onto his credit card. So before we evaluate this, we first want to explain why this is so important. See, once Frederick gets started with velocity banking, what he's going to do is he's going to pay all of his monthly eligible expenses through his credit card. The reason for this is because Frederick is looking to achieve the lowest average daily balance possible to pay a smaller amount in monthly interest. So you might be wondering, how does Frederick paying all of his expenses onto his credit card help him pay less in interest? Well, that's because what Frederick is going to do as soon as he gets paid is take his monthly income minus any expenses that cannot be paid onto his credit card and make a lump sum payment onto his card. And what this will do is immediately lower his balance on this card. But of course, Frederick will still have all of his monthly expenses that he will need to pay. But the key thing here is that Frederick will not need to pay all of his monthly expenses right away, as they will come due at different times throughout the month. For example, maybe on the 1st of the month, Frederick pays his phone bill. Next, on the 11th, he buys his groceries. And then on the 14th, he pays some sort of medical expense, and so on. As you can see, as each expense comes due, Frederick's balance slowly creeps back up. And by virtue of the balance slowly creeping up, this allows Frederick to achieve a lower average daily balance. See, when the bank calculates the average daily balance, what they'll do is they'll add up the balance on each day in the payment cycle and then divide by the number of days that are in this payment cycle. So since the balance is slowly creeping back up, this can allow Frederick to achieve a lower average daily balance, which again is going to be the number that our bank is going to use to calculate the monthly interest charge. So with all this in mind, the more expenses that we can pay closer to the end of the payment cycle, the lower the average daily balance we will be able to achieve. So now going back to Frederick's monthly expenses. Ideally, Frederick would like to pay all these expenses through his credit card, but unfortunately for most individuals that is not a feasible option because things such as rent and utility payments can typically not be paid onto a credit card. In the case of Frederick, he has $1,100 in monthly expenses that cannot be paid onto his credit card. This leaves him with $3,550 in expenses that can be paid onto his credit card. So upon receiving his income, Frederick is going to take all of his monthly income minus $1,100 and put it all onto his credit card. The $1,100 will then be left into his bank account to cover his expenses that cannot be paid onto his credit card. This then leaves Frederick with $4,720 that he will put onto his credit card each month, which will immediately lower his balance to $10,135. If you are someone who has multiple credit cards that you're looking to pay off, this is where you're going to have a decision to make. Mathematically, it makes the most sense to focus on paying off the credit card with the highest interest rate first. However, you will not be able to allocate as much income to this card because you will still need to satisfy the minimum payment on the other cards. For more information on using Velocity Banking to pay off multiple credit cards, we'll leave a link down below in the description to one of our videos that goes into much more detail on this topic. Moving on, Frederick has now lowered his balance to $10,135, but of course he still has $3,550 in expenses that need to be paid through his credit card during the month. This will cause Frederick's balance to slowly creep back up to $3,685 at the end of the month. And by virtue of this balance slowly creeping back up, Frederick has been able to achieve a lower average daily balance of $11,555. So let's pause here and compare the average daily balance to scenario number 2, which would be if Frederick didn't use Velocity Banking at all. In this scenario, Frederick would just take his leftover monthly income of $1,170, which is calculated by taking his income and minusing his expenses, and pay it all onto his credit card, which would bring his balance down to $13,685, which would also be equal to his average daily balance. So let's now compare scenario 1, which is using Velocity Banking, to our second scenario, which is not using Velocity Banking. Both scenarios, of course, will still have the same credit card interest rate of 22%, but the big difference will lie in the average daily balance. In scenario 1, the average daily balance will be $11,555, where in the second scenario, it'll be $13,685. So at his interest rate of 22%, an average daily balance of $11,555 would carry a monthly interest charge of around $211. On the other hand, with an average daily balance of $13,685, the interest charge would be around $250. So by simply changing the way in which he pays his monthly expenses, Frederick has been able to immediately save $39 in month 1. However, the benefits don't stop there. Since Frederick is now paying the majority of his expenses through his credit card, he can accumulate more cash back or rewards from his card. In Frederick's case, he earns an average of 1.3% cash back on all purchases. So by virtue of paying an additional $3,550 in monthly expenses onto his card, Frederick will now earn an additional $46 in month 1 savings, bringing his total month 1 savings to $85. Now, though on a month-by-month basis, these savings can seem relatively small, over time they really can make a huge difference. As well, by successfully implementing Velocity Banking, Frederick has shown that he can come up with a plan for his debt and stick to this plan. And in the long run, this can really go a long way. This is because for many individuals who are struggling with debt, they're struggling due to the fact that they cannot take psychological control over their finances. And yes, it's important to recognize that this psychological impact can be a positive thing for people who can successfully implement Velocity Banking. It's important to recognize that this psychological factor can also be the biggest risk when it comes to using Velocity Banking. And that is because we are paying all of our income onto our credit card for the purpose of then using that credit card to pay our expenses. However, when we put our income onto our credit card, we are immediately lowering the balance on the card. And this is really where the risk starts to arise. If we start to use this room for unplanned purchases not related to our expenses, then we can quickly put ourselves in a much worse place than where we started. That is why at the start of the video we mentioned that this strategy usually mathematically makes sense, but that doesn't mean that psychologically it makes sense for everyone. If you're someone who in the past has struggled to control your spending, this is likely not the appropriate strategy for you, as it really opens up the risk of things such as compulsive spending. Thank you for watching today's video. And again, our one ask is if you did get some value out of the video, be sure to leave us a thumbs up and consider subscribing to the channel for more content related to debt, Velocity Banking, and everyday finance.